All right, guys, today is an exciting day because this will be my first episode in English. And also my first episode, what is not live. So we are talking today to Emmett Kilduff. He did a master's in e-commerce in 1999. He's a former investment banker, Morgan Stanley and Credit Suisse, and he's the co-founder and CEO of the Fortia group. They help e-commerce entrepreneurs to get their best deal when they sell their business. Emmett, welcome.
Thank you for having me, Baz. Great to be here.
This is a Dutch song, but it's about freedom.
Very
and
cool.
You can run your business on your flip-flops.
Congrats to all the Dutch listeners for the Formula One victory on Sunday.
That was great. Yeah. So the last sentence is that we're cracking the code of life for sure. But yeah, you're talking about Formula One. Are you a fan of Formula One?
I am, yes. Actually, when I did my degree in business school, I did a logistics project on a Formula One team. At the time, it was the Jordan Grand Prix team, owned by a fellow Irishman. And that was a fascinating insight into the whole world of F1.
Wow. Yeah, I watched every single race and it was like, yeah, it was just a great ad for the Dutch guys. But
yeah, absolutely.
It was absolutely fine. Emmett, the first question is a bit off topic, but it's very personal. I always ask this question in my podcast. Hold yourself. Emmett, what would you do?
Okay.
What would you do if you had only 3 months to live?
Oh my goodness. Well, my favorite thing is skiing. In fact, I've just come back from the Alps last week where the snow is the best start to the season in 20 years. So I would definitely do a lot of skiing. I would and spend as much time as possible with family and friends.
Yeah, great. Are you also doing stunts and jumps and stuff like that, or just go as fast as you can?
Maybe some stunts off piste or après ski as opposed to on the piste. As an Irishman, I'm probably pretty good at après ski as opposed to on ski.
Right. Nice. Great, man. Emmett, nice to have you here. Maybe before we start, I also did a short introduction, but maybe tell a bit where you grew up and yeah, how you take the big steps to here.
Sure. So I was born in Canada, moved home to Ireland when I was a young boy. Did school and college here in Dublin, Ireland, and then moved to London to do investment banking after my master's in e-commerce, which was the first of its kind, certainly in Europe at the time. So I've always had an eye on e-commerce. I joined Credit Suisse because they were the leading tech bank at the time, did all the dot-com IPOs 20 years ago. And then I moved across the street to join Morgan Stanley, who are one of the leading M&A firms. And that was an amazing experience. Like Morgan Stanley, Goldman Sachs are the top two globally at M&A and exits. It was through that I was inspired to set up a data company, another business I have called Eagle Alpha, and that's a broker of data to hedge funds and private equity firms, but also aggregators of Amazon brands. And one of the clients of Eagle Alpha is a hedge fund in New York, and he happened to be best friends with Carlos Cashman, who's the founder of the biggest aggregator, Thrasio. I got to speak to Carlos in early summer 2010, before this whole world of aggregators was known, and it just intrigued me. Having done a decade in investment banking, M&A, and a decade in data, I thought the two could combine really, really powerfully to set up a new company, which is the Fortia group. And so I couldn't resist getting involved in the space in some way. So I became executive chairman, moved from CEO to executive chairman of my other business, Eagle Alpha, to free up time to be co-founder and CEO of this business, the Fortia group.
Wow. Well, that's a nice story. And about this masters in 1999, you were talking about, like, how did that look like? I mean, there was no no SaaS software, no systems, nothing. It was just everything from scratch. You had books telling you about e-commerce, or?
Well, Baz, there was very little books even. There wasn't any sort of real the standard literature to read. It was really about case studies at the time, because of the dot-com boom. There were a lot of crazy valuations going around and crazy startups and unicorns, and it was about doing case studies on those and learning from their founders. So yeah, really fascinating. It was actually a great way to learn. Instead of just being told to read all these books, it was more by meeting people you'd respect, founders you'd respect, and learning from the people that were actually doing the work.
Yeah, wow, nice, very nice. And about Thrasio, so you know Carlos already before he started Thrasio then?
No, sorry, he started Thrasio maybe 3 years ago. I started speaking to him about a year and a half ago.
Ah, right. Yeah, got it. Yeah. It's a small space. All the aggregators know each other. But I mean, for the Netherlands, we are the first Dutch aggregator ever. We are already active for maybe a year, and there is actually no serious other Dutch aggregator already in the market. We are still thinking like, how is this happening, or why is this happening? I mean, the Netherlands is a small country, and everything is not that matured yet here, and yeah, I mean, obviously we are taking a big advantage of that, to being the first, having a big platform called bol.com. But there is a lot happening in this space, in this aggregator space. You are with both feet in that, so we are going to deep dive in that in this conversation as well. It's a crazy time, right? I mean, literally the billions are falling out of the sky to fund all these aggregators, and then it's a kind of rat race, like who gets the best brands first.
It's incredible. It's really, since November 2020, there's been over $12 billion raised by 89 aggregators, Amazon aggregators. There's also DTC aggregators, but 12.5 billion raised by 89 aggregators. I think that number will clear at least $20 billion by the end of 2022. I think the time is up for copycats of Thrasio. I think now the new aggregators are niche focused, either by geography, such as LATAM, India, South Korea, Japan, or by category, such as wellness and so forth. So I think any new aggregator will be niche focused, but the quantum of dollars going to the existing successful aggregators, such as Dwarfs and others, will continue to grow. In fact, we've been mandated by some credit funds to do due diligence on aggregators to help them decide whether they want to place credit to the aggregators and how much. And we're seeing it direct. The numbers are going to be huge in 2022.
Ah, yeah, that's great. But tell me maybe a bit more about the role of the Fortia Group in this whole aggregator spectrum, because you help e-commerce sellers to get their best exit, probably to the aggregators, or even for you, it maybe doesn't really matter where you sell to. Tell me a bit more about that.
Yeah, so we set up the Fortia Group to make sure entrepreneurs get the fair and best deal when they exit. It's their biggest payday event, right? Is when they do all the hard work, they build a business from nothing, and then they deserve to get the best deal.
Yep.
And a lot of entrepreneurs advise or don't hire an advisor, which I think is a big mistake. It's their first rodeo. They've never done a deal. They don't approach all the right investors, and there's stats out there that show if an advisor is hired, they can get up to 25% higher valuation. And the highest sticker price doesn't always mean the best deal. And maybe that's something we can get into, right? Because the devil's in the detail of the actual terms.
Yes.
Surprisingly, in a survey we did recently, 46% of term sheets were not reviewed by lawyers. That's just crazy, right? So there's a huge education piece to be done, and ultimately, we want to make millionaires of as many e-commerce entrepreneurs as possible, and we want them to get the best deals as possible. Whether that's to an aggregator such as yourselves, or a private equity firm, or a competitor, or a corporate, depending on the size of the deal. And certainly the larger deals are attracting a lot of private equity interest.
Yeah. So what are the kind of maybe biggest mistakes you see people making when they want to sell their business, or is there something like, where you probably help them with that, but what kind of mistakes are they making?
Well, I think prepare to fail, fail to prepare to fail, right? So I think the first mistake is when a lot of entrepreneurs get an email from an aggregator and they've signed an LOI within 2 days, an LOI being a letter of intent. That's ridiculous. It's crazy. This is your baby that you built up over, 2, 5, 7 years. If you want to exit in 2022 or 2023, start planning it now. When I was at Morgan Stanley, we used to do IPO ready programs 2 to 3 years out. So, large corporates are thinking about their IPOs or exits 2 to 3 years out. So entrepreneurs who want to get the best deal should be thinking the same way. So preparation is the key. There's lots of things you can do from a preparation perspective on the operational side, but also the corporate finance side. So from an operational perspective, one of my co-founders is an e-commerce expert, and he can help advise on tweaks to make your story stronger and increase revenue, net margins, and so forth. On the corporate finance side, the sooner we can work with an entrepreneur to speak to their accountant, lawyer, think about tax structuring, think about KPIs and how ultimately the business will be pitched to investors, the more we can help. So that's the biggest education point or lesson I would give to entrepreneurs is start preparing as soon as you can.
Right.
Don't just wait till the end.
Yeah. Well, yeah, I just told you that the Dutch market is not that matured yet. So maybe a lot of you are talking about right now, like listeners are thinking, what is this guy talking about? But maybe you can take the listeners or someone who's watching this on YouTube of the process of selling. So what are the steps that are being taken before they actually sell or getting close to a deal?
So there's the whole preparation, which we call exit ready, and that can be a few months up to 2 years, 3 years. When the entrepreneur actually presses the green light to start a formal exit process, there's 7 steps in that process. In our process, the first is preparation. In terms of preparing the documents. So thoughtful 1-page teaser to grab the attention of the M&A folks at the buyers. A 50+ page info memorandum, an online data room with all the relevant data structured by supply chain, finance, and so forth. That's sort of step 1. Then it's all about getting the marketing going, the distribution. So you need to approach all the relevant buyers, whether it's any one of the 89 Amazon aggregators, any one of hundreds of relevant PE firms if the brand is big enough. And so forth. We prefer a rifle shot approach as opposed to a machine gun approach. Some people will blast out a teaser to hundreds of targets. We prefer to be a little bit more thoughtful and spend more time approaching a smaller number of targets. When I say smaller, it's still tens of targets. After marketing, then it's about getting as many LOIs back from these bidders. Surprisingly, 36% of entrepreneurs only get 1 LOI. And one of the reasons for that is they do the deal themselves and they just sign an LOI with the first person that offers it to them. To get the best deal, you need to have a competitive auction process. And that's where certainly an advisor like Fortia can help. When you get all those LOIs in, it's the devil's in the detail, as I mentioned. It's about trying to compare them in a like-for-like basis as best as possible, looking at how much of the consideration is upfront versus deferred. How realistic is the deferred component of the consideration, and so on. Ultimately, then it's about giving exclusivity to one of those preferred bidders that you feel you want to give your baby to, and that you feel is rewarding you for all your hard work. The bidder usually wants 2 to 3 months of exclusivity to roll up their sleeves and do due diligence. The due diligence is incredibly intense. There's various work streams such as supply chain, marketing, finance, product roadmap, and so forth, where the Fortia group, the company's accountant and lawyer, will advise the entrepreneur to make sure that they're not being out negotiated and are getting ultimately a fair hearing. That all leads then to a document which seals the deal. That can be either an asset purchase agreement or a share purchase agreement, depending on whether you're selling the company or just the brand.
What's the trend in that? Like, do you see more asset deals or more share deals? Or
well, in the States, they're predominantly all asset purchase deals, because it's from a tax perspective here in Europe, depending on the jurisdiction, it's more tax effective for the entrepreneur to have a share purchase agreement.
Yeah.
So yes, certainly in most European countries, we're seeing SPAs, but the buyers prefer APAs because then they don't have to take all the associate risks and liabilities that come with a company, as opposed to just buying the brand or the Amazon account.
Yep.
So ultimately, then it's about signing that document and doing other completion documents with the lawyers and their advisors. And then you sort of move to post-completion stage, where depending on the negotiation and the wishes of the buyer and seller, the founder will stay on in some capacity. It could be as a consultant, it could be as an advisor, or maybe it's on a full-time sort of brand manager basis, depending on the scenario. And then it's about trying to get the entrepreneur as much of the earnout as possible, much as the deferred component as possible.
Mm-hmm.
So that's a quick run through of the steps. We last summer, Baz, we published an exit guide, a 70-page exit guide for Amazon entrepreneurs, and we're in the midst of updating that for edition 2, which will come out in mid-January, and that goes into sort of all of that process in a lot more detail. And we can send a link to your community.
Yeah, that's so great. We'll paste that one in the show notes. Yeah,
great.
That's great. Yeah, talking about the last end, about the earnouts, maybe you can explain a little bit more about that, and also if people still have any influence on that when they run a business.
Earnouts were designed or created by buyers. They favor buyers. They don't favor sellers. They're used on big Wall Street deals as well as here in the Amazon space. They're structured to de-risk the acquisition for the buyer. So if you're buying a business, rather than giving 100% upfront, it's better to give less upfront and then only pay out a certain amount if the business hits a certain amount, a certain threshold. There's various thresholds that you can be measured by. It can be revenue, it can be SDE or net profit. SDE stands for seller discretionary earnings. Or other points. From our perspective, we think that revenue is the clearest metric to be based by, because it's harder to manipulate. Whereas as you go further down the profit and loss account, there can be further room for manipulation. At the moment, we're seeing deferred components be approximately 25% of the consideration. So 75% upfront and 25% is deferred. And I think that's probably the right balance. There are some exceptions. There were, in the survey we did of sellers who exited, there were 4 that said they got 100% upfront. That's unusual. I don't expect to see that as much. And I think more businesses that have a DTC component as opposed to an Amazon component will probably have higher earnouts. Or if there's supply chain concerns, which clearly is quite prominent at the moment, there might be need for further earnouts.
And but the earnout, like most of the times, it's linked to the future growth, what the aggregator will to what level they take it, right? And then there is a kind of, then the earnout is linked to that. How often do you see then that these earnouts are paid or not paid, or maybe they get discussions about it? Is that common?
Yeah, exactly. So it's a really important for not just the buyer to do due diligence on the seller, but for earnouts, it's important for the seller to do due diligence on the buyers, because you need evidence that the buyer has a great capability to increase the operational performance of a brand. And all the buyers say they're brilliant at that, but you need to look under the hood and do some due diligence. So it's important to we help sellers think about whether that buyer will still be in business in a year's time, because some aggregators are going to go bust. The majority won't, but some will. B, show us case studies where you've demonstrated real fantastic growth of brands that you've acquired. And we don't want to just hear your word for it. We want ultimately testimonials from the people that sold those businesses to the buyer. So there's a lot of due diligence to be done for a seller to get real comfort that they will deliver that aggressive earn-out metric that they've proposed in the LOI.
Okay. But yeah, you just said some aggregators will go bust, but how do you see that, and why are they going bust?
Yeah, it's really interesting. There's this theme in the space that the consolidators will get consolidated. Yes. And the first stage of that is distressed aggregators will get consolidated, which is happening. And the second stage is high quality aggregators will get consolidated, which might start at the end or well into next year or 2023 and beyond. So now what we're seeing is aggregators that have raised some capital. They've either not being able to run the brands as well as they thought they could. Valuations are getting higher in a lot of instances. Interest rates are probably going to go up or will go up next year, which will be a catalyst for maybe tougher covenants by the credit funds that are lending all these aggregators money. But in short, it comes down to operational performance. So if an aggregator isn't able to demonstrate amazing operational performance post-acquisition, they're not able to get more equity or credit. And then this whole thing starts to unravel. The good aggregators are those that are the best at operating, and they're able to get more equity and credit. And you've seen the crazy fundraisings of Thrasio Perch and others. So they can continue to keep the flywheel turning. We've seen at least 3 aggregators come to market in 2021 that are effectively what I would call distressed sales. They haven't been able to make it work and are looking for a bigger aggregator to take them over.
Ah, okay. And then the bigger aggregator can take these guys over for low multiples, probably, or?
Yes, for low multiples, and get hopefully good colleagues, good people, and integrate them into their team, because a lot of these aggregators have huge staff shortages given the scale of pace that they're growing at. So in some ways it's an acqui-hire, as in when it's effectively acquiring the people, not really the company.
Yeah, got it. Yeah. Yeah, that's interesting to see how that will play out in the future with all the aggregators in this space, because it's I mean, for the aggregators, it's a game about money and growing brands, right? I mean, that's the most important, because if they don't get the money, they can't buy the brands, and then they can't even grow it. And also, it's very important. You also see people stepping into the space. You think, oh, it's a nice business model. They don't know anything about e-commerce. They just raise the money and then they see how they do it. It's something that's not often a good formula if you don't know anything about e-commerce. But yeah, you can hire people. They can also walk away. So that's a big risk as well.
Yeah.
Yeah, we should talk about COVID as well, because how do you see COVID affecting all these companies? Because obviously COVID is good for e-commerce because it really went through the roof last years. But we see big challenges in logistics. These things are raising like crazy. We see like all the textiles, plastics, everything is raising through the roof as well. Even the gas prices rising like crazy. How do you see this affecting these companies, even from the aggregators' perspective, or people who want to sell their business?
Yeah, well, I agree. I think COVID has been good for e-commerce in general at a macro level. There was the COVID boost was incredible for a lot of e-commerce companies at the time. Well, for the brands and the aggregators, but we've sort of got through that now. So it's actually making it difficult to compare now versus then, because then was so high. It's hard to perform as good as the COVID period. So I think there's more realism coming into performance now. But it's forced a lot of issues such as supply chain, and that's at a brand level and an aggregator level. It's important. At a brand level, it's made a lot of companies that had 20% net margins this year, at the start of this year, dropped to 15% type net margins, because of supply chain costs and other things like PPC costs. But that's really difficult for a brand owner. If they had sold in Q1, they would have got frankly a higher multiple than now if they're selling with 15%. it's also hard for the aggregators then, because they're having to accommodate and adjust to all these headwinds, all these increasing costs. But at least they have the balance sheet and the power and the resources to sort of get through these. Like ultimately, supply chain costs will reduce. Hope maybe not back to fully where they were, but they will reduce, and they have the ability to ride through those difficult periods. So from a brand owner perspective, those that have lost or had declined margins need to be more realistic from a valuation perspective. A lot of people we've spoken to have said they don't want to sell now in Q4. They want to wait until they get their margins back up, or at least go on the right trajectory. Mm-hmm. I think overall, based on our conversations with aggregators, there was 300 to 400 FBA exits in 2021. We think there'll be close to 1,000 in 2022. And so the quantum, there's a huge clearly demand of dollars that have to be deployed, and the quantum of deals is definitely going to be increasing. But in some cases, people will have to be realistic on valuation.
Yeah. I also saw that like on days like Black Friday and Cyber Monday, that the prices were actually higher than last year. Because otherwise you're simply losing a lot of money, and also see people actually raising their prices on these days, because then they are the most sales, and then they actually make some profit.
Yep.
How do you see this whole game? All these aggregators together, the sellers, the money is what's flowing into the market. Is it this question probably you got a lot of times? Is this a bubble or not?
No, I don't think it's a bubble. Again, even with all the aggregators, $12 billion, if that was actually all spent, it's a tiny amount of the dollar value of all the brands on Amazon. It's less than 5% of what's on Amazon. So it's still a drop in the ocean in terms of the Amazon FBA market. There's lots to play for. In one sense, the way I look at it is, a year ago, there were no online department stores on Amazon, and now there's 89. There's room for lots of department stores. And so that's a basic way to look at it. I think there'll be lots more aggregators, again, in the niche area, as opposed to, the Me Too of Thrasio, and there'll be lots more capital coming in. There will be IPOs of the bigger aggregators next year, which will be one of the catalysts to drive consolidation of other aggregators.
Yep.
But yeah, I can see lots of these surviving and thriving. There's also aggregators doing slightly different plays. So you guys look at a lot of off Amazon marketplaces, which is a different strategy that's unique. There's another aggregator in Europe looking at Eastern European marketplaces. Mm-hmm. So there's lots of niche strategies where there's actually very few competitors. You mentioned you're the only guys in the Netherlands. There's one that's the only aggregator in South Korea. There's only really two in China, in a country that size, right? So there's still huge opportunity. I don't think it's a bubble, given the equity value creation being created. How many unicorns of the 89 aggregators that are effectively 1 to 2 years old, how many unicorns have been created? Yeah. The answer is close to 10 within 12 months. That's insane.
That's crazy.
So there is value being created. And valuations of the brands will go up. There will be headwinds, but the really good operators will ultimately, create super businesses.
Yeah, that's great. Because also I see the market, because these aggregators, most of them, they have healthy businesses on its own, because they are profitable. And this is not a winner takes all market. Even if you have more players in a country or all over the world, they're close to 100 aggregators. You just pull up the number, but yeah, they just have healthy business on their own. I think the first phase is the most difficult part, because then you start building the team, you start acquiring. You're not profitable yet. You have a burn rate, but once you are EBITDA positive, or you make profit, then you are actually have a good chance to survive and make it till the unicorn status.
Yeah, Yeah, I agree. Again, the winners will be those that are the best operators, because it's easy to spend money. If I'm given 100 million, I can go out and buy lots of businesses. That's relatively easy. Yep. To do. It's harder to buy the best businesses as opposed to just buy a business. But the real value add is having brilliant supply chain people, brilliant brand managers, brilliant PPC people. But then I think the firms that really succeed are also those that will really integrate technology and data into their efforts. And very few aggregators are doing that today, which surprises me because I'm a sort of tech and data guy with my other business, Eco Alpha. If PPC starts to go really well on a specific brand, is that talking to the supply chain so that more stock is coming through? In a lot of cases, it's sort of done by Excel, or it's sort of offline. It needs to be a seamless technology system across all the departments and an aggregator to make that work properly. That's just a really basic example, clearly, but some aggregators are taking tech and data seriously, others aren't. From a seller perspective, that's important, because if you have a 25% of the consideration deferred as an earnout, you want to know that A, the aggregator is going to be around, but B, that they have the best systems in place to really squeeze out as much revenue and profit from the brand that you sell to them.
Yeah. Actually, if you sell your brand, you actually want to have a live dashboard to watch how your brand is still performing after you sold it.
Yeah, exactly. Yeah.
No, or maybe tell me a bit more about this technology and data, how you see that, and how they can even win a lot more out of that in your eyes.
From an aggregator perspective, I think tech and data can be used for three areas. One is lead generation. Two is due diligence and brand management. And one is lead generation, two is sort of due diligence, and three is brand management, operational performance. So from a lead generation perspective, the best aggregators are leveraging tech at scale to target brands. So, for example, there are aggregators that are crawling Amazon at scale, analyzing the BSRs, the ratings, the reviews of all brands on Amazon, with the view to prioritizing which ones to approach. Some are doing that on proprietary web crawling basis. Some are buying data sets in that have done that analysis. Mm-hmm. That's sort of step one from a lead gen perspective. Unfortunately for the brands, that means they're getting spammed all the time by some aggregators saying, please, can you speak to us? From a brand management perspective, there's so much, from a technology perspective and then a data perspective. From a tech perspective, ultimately, I think the leading aggregators will either build or buy brand management software, so that supply chain, marketing, brand managers, the defense councils all can be singing from the same hymn sheet. Sorry, were you going to ask a question?
No, yeah, I'm just wondering if there are already systems out there what bring this all together. I mean, at the end of the day, it's a kind of spaghetti ball, and you try to tie it up together in the middle.
Well, there are actually. We're working with one that was born out of an Amazon agency in the US. They created a software subsidiary about 3 years ago that can manage all this for aggregators, and we're working with them to introduce them to aggregators. Ultimately, they might get sold to an aggregator, in my view. Right. So some aggregators are doing this. Some of the bigger aggregators are doing this themselves, but it's surprising how late in the journey of an aggregator they actually hire a CTO or a head of data science. Even Thrasio didn't hire a CTO till 2 years in. So on brand management perspective, then there's also data. So there's a lot of data that can be acquired. And my other business, Eagle Alpha, can help advise aggregators on which data to acquire for various things, like traffic to the GTC website and data about what that's being crawled from Amazon. And then it's post-operational value creation. So it's about trying to think what tech or data can help or empower the brand managers to make the best decisions. So they need a dashboard that brings in all relevant information to help them decide in their daily stand-up what they need to do. It should be tech and data empowered rather than, just reviewing with eyes, what's happened and so forth. So there are some examples that's just tipping at the surface, but tech and data should be
in the heart.
Should be in the heart.
Yeah, I think it's very important. You have a few slides, right, where we have some facts and other figures about this whole aggregator space and what you collected in the market. Maybe we can pull it up and discuss a bit more about that.
Sure.
Because at the end of the day, it's a very exciting space. A lot is happening, and you guys are talking to a lot of sellers, also to a lot of aggregators. Are you selling most of the businesses to aggregators, or is it sometimes that some big ones you sell to other companies?
I think once you get towards 10 million in terms of valuation, Baz, then private equity begins to take an interest. So, for example, in August, we sold a gummy supplements business called BeLive to a German private equity firm for $17.5 million. But most of the deals sub 10 million would sell to one of the aggregators.
Yep. Nice.
Yeah. So in November last month, we did a survey of sellers who successfully exited their businesses, and I thought it'd be helpful to walk you and your listeners through this at a very high level.
Yeah, sure.
So we had 32 sellers complete the survey just over 4 weeks ago. So we asked them, when did your brand start selling on Amazon? And, interestingly, maybe not surprisingly, that most of the businesses that sold have been at least 4 years old. So it's difficult to get something that's only 1 or 2 years old to a sale. There needs to be, typically buyers want to see at least 2 years of data points to look for seasonality and other trends before they're willing to acquire it.
Yeah, it makes sense. So they want to have this history and to see that year-over-year growth in the brand. Yeah,
exactly.
Yep.
When did your brand exit? So, we couldn't have had this conversation probably 3 years ago. It's only really in the last 2 years that this whole space has taken off. So now there are 89 aggregators. In 2018, there was probably none. So it's a great time to be a seller. There's a proper exit route instead of, a really difficult process of trying to find the ultimate buyer.
Yeah, and before that, it was even very hard, or even a lot harder to sell your e-commerce brand because I saw some numbers as well. Maybe it's in your presentation as well, that the average time if you want to sell your business, how long that takes. Because before it took maybe 6 to 12 months, maybe longer, and now you can exit in a few weeks if you want to.
Yeah, in the normal M&A world, it does take 6 to 12 months or sometimes longer for very big acquisitions. It's really unusual in the Amazon space that deals can get done in weeks as opposed to months, but that's great for sellers.
Yeah.
Really interesting to see that the main category of exits was pet care.
Oh, wow.
You asked about COVID earlier on. COVID is a catalyst for pets, and pets is a catalyst for pet care products. And so there's huge interest in that as a category. Sports and fitness, we were all locked up. We couldn't go to our gyms. So clearly that took off as a category as well. Supplements is on the other hand, the category where there's the least acquisitions. I think from an aggregator perspective, there's still uncertainty about Amazon's view of supplements. So that's maybe one reason why buyers are shying away from that category.
There's a lot of error as well in this category, right? Obviously they're making high margins, but you don't know where to go to.
Yeah, there are definitely some aggregators we know that like that category, but it's clearly it's not the top of most aggregators' lists. This has changed over the year. So if you had asked me this question at the start of 2021, I would have said that most aggregators will only want to speak to brands that have 90% of their revenue coming from Amazon. But that's definitely changing as we went through 2021. there's more of an acceptance for some of their revenue to be off Amazon on other marketplaces such as Ball or equivalent marketplaces around the world. And I think this is a growing trend. I think, aggregators want to buy really, really good brands that are sustainable, and really good brands should be able to be sold on an omni-channel basis, not just Amazon or other marketplaces, but also DTC and ultimately offline. So I think this trend will continue. I think we'll see more aggregators buy pure off Amazon businesses as well.
Yeah, I think that's also the big challenge for aggregators to go multi-channel, have other channels as well that are growing, like their web shops or other B2B channels as well, or even more smaller marketplaces besides Amazon. That's the biggest challenge, I think. So that's also why it makes more sense to have a more diversified channels in when they buy the brand as well. Yeah. What I saw, what also I think Atrasio is doing is that they make a choice that they have, like if they buy a brand, for instance, in Germany or whatever, and they are on other smaller marketplaces, often of the times they just kill the small marketplace because they don't know and they don't want to run all these small things. They just have a highway called Amazon, and that's also what I see in the market.
Yeah, I think it's the 80-20 rule. I guess some of the simpler ways to increase revenue in the short term is on Amazon, by bringing something that's on Amazon UK to Amazon Germany and so forth. But in the long run, the aggregators will have to learn how to work with all marketplaces, in my view. I mean, that's definitely long term. And again, that comes back to the tech question. You need technology to help you do that. Otherwise you'll have to have teams focused on each marketplace, and it won't be as seamless as if it's without tech.
Yeah.
And this one really shocked me, Baz. How many LOIs did you receive? 36% only received one LOI. That it shocks me, but also saddens me. If entrepreneurs are going to get the best deal, they need multiple LOIs.
Yeah.
Because you need a few buyers really interested in your brand, and you need to not play them off against each other aggressively, but just it helps you get the best deal and the best terms.
Yeah, maybe just explain for the listeners as well, like the LOI is the letter of intent, what means like, okay, this is the draft. You give them, well, I want to give this amount of money for your business, and you give me exclusivity to do a deep dive into your business, called due diligence for like 3 or whatever months. I mean, also these periods are different per LOI, right?
Yeah, exactly. It's a non-binding document which sets out the key terms that a buyer will offer a seller, but it's important to get a few of them, and the devil's in the detail in the document as well. It's again going back to that phrase: the sticker price could be high. Don't always go with the highest price. That's not necessarily always the best deal. Yeah,
so 36% only receives one LOI, and then. But how do you see this in terms of size of the business? I think maybe the bigger the size, the more LOIs you want to receive. If you have a business of, I don't know, 1 million or a couple of 100Ks worth, maybe it's less important to have 6 LOIs, or how do you see that?
Yeah, I think there's probably some correlation with size. I think the main correlation will come with quality. So for the higher the net margins, the most likely the higher correlation with offers. And frankly, if you have an advisor, you would be getting more LOIs as well.
Mm-hmm.
This one shocked me as well. 43% didn't ask their lawyer to review the LOI. That's really crazy, because there's lots of terms that you would sign up to an LOI that will impact the ultimate document that manages the whole transaction, whether it's and so you've already started to negotiate lots of the key terms that ultimately you'll base your end deal on, which is contractual and binding. So it's really important to have a corporate finance advisor like the Fortia Group, a lawyer, and also an accountant review the LOI before you sign it. I think it's crazy that people are signing up without advice.
It is actually. It's shocking.
yeah, it's shocking, and they're also signing these things too quickly. We asked the sellers, are too many entrepreneurs signing LOIs too quickly? Agree or disagree? And 67% said they agreed. But in fairness, some aggregators, are not saying Dwarfs does this, but some aggregators, are very, very aggressive and are sort of asking, contacting an entrepreneur on a Tuesday and saying, here's the LOI, you need to sign up by Friday night.
Yeah.
That's not a good way to do business. And I think ultimately those aggregators will get a bad brand name for themselves. But from an entrepreneur perspective, take your time. This is your biggest payday. Fail to prepare to fail. Don't just sign the first one. Get some advice. Take a step back. If you're offered one LOI, it probably means you can get offered 5. So just take a step back and think about a proper process.
Yeah. Yep. Makes sense.
This was interesting, and I think this again will change over time. Baz, what was the last 12-month revenue of your brand at exit? So clearly, the majority are in the $1 to $3 million range. This is going to change because, as we mentioned earlier, there's now $12 billion with the aggregators to deploy. They can't deploy that all with $1 million acquisitions. It's just impossible to scale. So a lot of the aggregators early this year, might have had a minimum threshold of $1 million revenue. We're seeing that go to 3 or 4 million revenues. So the aggregators will be forced to do bigger deals. So I think if we look at this chart in a year's time, there'll be a more skew towards the higher rows, the sort of the $5 million plus levels.
Yeah, they have to. So what is like? There are obviously less companies that do $5 million plus, but yeah, these are important targets for the aggregators, right?
Yeah, they are. There are. There's about 50,000 businesses on Amazon that do over $1 million in revenue. So that's sort of the total addressable market, and that number is
that all over the world. The 50,000.
Correct. Yeah.
Okay.
Yeah, but some of those might have too many SKUs. Some of them might be in categories that a buyer doesn't want, like apparel or complicated electronics. So the number is actually smaller once you apply the acquisition criteria of a specific buyer. So then, this is key to me. What were the net margins of your brand at exit? And I was actually surprised that so many had really good net margins, like 43% have margins in the 25 to 30%. That's really hard to have margins in that bracket.
And still in profit time then with the high logistics costs.
Well, yeah, these deals, the survey respondents was the last few years. So it's getting harder and harder to get into that top row.
Yeah.
But it does show you, if you have margins in the 25% plus, you will absolutely should be expecting 5 plus LOIs letters, right? You shouldn't be expecting 1. That's a really, really great business that you've got, and so you should be having a proper competitive auction.
Nice.
As you say, I totally agree. I think if we do this survey in a year's time, there'll be more in the 15 to 20% bracket.
Yeah. Yep.
Valuation is always one of the most exciting topics for your listeners, no doubt. What multiple did you get for your brand, including upfront and deferred revenue? So the majority got between 4 and 5x SDE, which stands for seller discretionary earnings. Think of that as effectively net profit plus some add backs like founder salary and so forth.
And maybe we should talk a little bit more about the difference between SDE and EBITDA, and also maybe explain what it is, because maybe some of the listeners don't even know what it is.
Yeah, look, I think there's a lot of add backs that can be added on to net profit for Amazon businesses, such as founder salary, such as non-recurring costs. And there's a long list of those, and they're detailed in the exit guide that we've published, which we'll send a link to in the comments. But it needs a bit of careful thought with your corporate finance advisor and your accountant to come up with the real SDE. And you don't want to come up with something that's too aggressive, because then the buyer will see through that and come up with their own version of SDE, which might be lower than you thought, and then you might have misguided all the buyers. So it's important to calculate the SDE correctly. From a context perspective, in 2020, the valuations were probably two to four. 2021, clearly we're seeing valuations stretch from 2 towards greater than 5x. The gummy supplements brand that we sold in August got done at 5.75x. Mm-hmm. And there are businesses getting sold, higher than that. The valuation then, so is it increasing or decreasing? I think is a fascinating question. Before I come to that, this may be a bit too much detail, but really good pieces of advice from entrepreneurs who actually sold their business. If they were to do it all again, what would they do differently to increase their valuation? So this is gold dust. This should be gold dust for any seller. So number 6, hire experts to exit my business. Number 11, get an accountant who really understands Amazon FBA, not just a bookkeeper. Wait longer to sign an LOI. Number 13. Yeah. Avoid stock FBA issues. If there's any supply chain concerns, that's a big no-no. And buyers will be very wary of that, especially given the environment we're in. Number 17, have less SKUs. Get rid of SKUs that aren't making money. So you clean up the business and make it, make it really focused on hero SKUs or exactly. really well performing SKUs. So there's a lot there to take in on this podcast, but hopefully your readers will have a chance to.
Yeah, one of the biggest upsides, and obviously, if you run an e-commerce business, it's hard to keep up with stock, and that obviously has to do with how much money you have. So the first quick win is don't go out of stock. If you have 1 year and you didn't go out of stock in that year, it probably gives you already an upside of maybe 20 to 30%. Yeah, that's the first win for an aggregator when you were out of stock that year, and then the aggregator can buy way more quantities and have the warehouse stacked. That's the first easy win.
Yeah, and look, most e-commerce entrepreneurs don't realize that there's at least 20 sources of revenue-based financing to fund all this inventory. So lots of people have heard of Clearco, but there are 20 competitors to Clearco, and one of the things we do is educate folks on what revenue-based financing is and who the players are, so that we can help them solve for that problem, get them capital to pay for inventory. Yeah, and certainly when we work with clients 1-2 years out, we can help them navigate that financing to make sure that it's fueling their growth. Nice. We touched on this a little bit earlier on. What's the split between upfront and deferred? So the majority is in 70 to 80% upfront, or certainly the majority is upfront with lots. There's lots deferred. I think rule of thumb is 75% upfront, 25% deferred. Clearly, for our clients, we try to get as much upfront as possible. Yep. But it depends on the situation. If it's a recovery story, if margins are down and there's a good plan to recover margins, then you would expect the buyer to request more deferred component. If it's a 30% margin business and there's 5 buyers submitting LOIs, then you can push for a higher percentage upfront.
Yep. Yeah, this is expected range, I guess, 70, 80% is most of the deals.
Yeah.
Payments, yeah.
So this is really interesting. So what's the earnout actually based on? Is it revenue? Is it seller discretionary earnings or net profit or something else? And we always try to encourage earnouts to be based on revenue because it's simpler to calculate.
Yes.
But surprisingly, 61% said other, which in essence means it's a combination of both revenue and SDE. I think the buyers would all prefer it to be based on SDE because also ultimately they get measured on that figure, or their actual brand managers will get measured on that figure. So look, it depends on the brand in case, it depends on the buyer you're speaking to as well. Ultimately, what it'll be based on.
Yeah, that's interesting to see. So some of the aggregators do actually then the revenue component. So they're not looking at the SDE then. when they do these earnouts.
Correct. Yep. Some some people, especially in competitive situations, where the brand is getting lots of LOIs, they have more power to dictate what the earnout's based on.
Yeah, exactly. Yeah. Makes sense.
This is important. It goes back to one of your first points on the call. Are these deferred components actually getting paid? Are they realistic, and are they getting paid? And thankfully, it seems like they are. 84% of people saying that the deferred component was realistic. We certainly see LOIs where the deferred component is crazy. It's shoot for the stars type stuff. It's just not achievable, and it leads to a sticker price that looks like the best deal, but frankly, the entrepreneur will never get that money. So again, the devil's in the detail on these things.
So is this the third component? Does it also include the stability payment, or is it only the earnout?
Yeah, we would include the stability payment as deferred. It's more guaranteed than an earnout, but it's still deferred as opposed to upfront.
Yeah, got it. And the earnout is obviously flexible based on their revenues or SDE or other what we saw in the slide before.
Correct. Yeah, exactly.
Yeah. And another question: what do you see on the earnout? Is it you see most of the time that they do the earnout uncapped, or do they cap it most of the time?
There's a real mixture, actually, Baz. We would encourage uncapped earnouts, but we've seen both. We've seen both. Again, if the auction process is run correctly and it's competitive, the power can lie with the seller to try and encourage an uncapped earnout. Once the LOI is signed, to some extent, the power shifts from the seller to the buyer, who then has an exclusivity period to do the due diligence. So it's really important for the seller to take their time and do all that negotiation up front before they sign the dotted line.
Yep, exactly.
This is really important, right? So a lot of bidders come in with really high sticker prices, and we asked the entrepreneurs, was there a difference between the valuation in the LOI versus the actual final valuation? And well, it was encouraging that more people didn't say there was a difference. 52% said there's a difference, which is frustrating for entrepreneurs, which means that they're signing an LOI with someone who then chips away, sometimes for legitimate reasons, but sometimes for non or illegitimate reasons. If it's because revenue of the company declines during a due diligence period, then that's fine. The valuation should decline. But if it's because they're being a little bit cheeky and looking for reasons to chip away, that's not fine. We detest that, and we're trying to protect, the David and Goliath scenario. We're trying to protect the small entrepreneur from suddenly having a worse deal.
Yeah, but is this shocking that almost half of the people get like a different amount for their brand than they are actually thought they would get?
Yeah, look, I mean, the real answer here should be 80%, 90% should be saying no, right? Yeah. So that most deals are exactly what they said they would be. You're right. In Q4, we've definitely seen lots of scenarios where, look, the margins have just gone down because it's tough. It's a tough environment, and that's fair for a buyer to renegotiate. But leaving that aside, there should be more red on this pie chart.
Yeah, from a seller perspective, I would say, okay, then I go to another aggregator. They will give me more.
Yes. Or go back to one that you were speaking with before. Yeah. But it's important. Ideally, you get this right. You don't want to keep going back to buyers, because you're selling a dead horse. Then, to some extent, you want to get all this done right the first time.
Yeah. Plus, you went through the whole due diligence probably before they give you the final valuation, and that also took time and emotion. At the end of the day, it's an emotional process for a seller.
Hugely emotional and incredibly intense. I mean, frankly, it's like having a second day job. You've got one day job to run your brand and another day job to do the M&A process. Which is why, again, and of course I would say this, but it's helpful to have an advisor to hold your hand for the second process. So with that in mind, yeah, we asked, why did sellers hire an advisor? What are the key benefits? The first is to maximize valuation. That's a key benefit that we can bring to the table. I referenced this. There was a study by the University of Alabama, which analyzed over 3,000 deals over 15 years, showed that advisors could get up to 25% higher valuations.
Oh, wow. So that is actually the real added value then from you guys as a Fortia group. Like if I'm selling my brand directly to an aggregator, or I use you guys to do it, probably I get a higher valuation then.
Yeah, well, if you go back to that slide, which showed that 36% of entrepreneurs are getting one LOI, you by definition, you're getting a low valuation or lower valuation. So it comes to the third point here. We know all the buyers, and so we'll put you in front of all the relevant buyers, which should get you a more competitive auction process and more LOIs. But it's also, the second point was great to see that it's just deal experience, right? If it's your first rodeo, you're going to make mistakes. It's David and Goliath. You're going to be out negotiated in some instances. I wouldn't sell my house on my own. I've never sold my house. Even if the Fortia group was being sold, I would hire an advisor to reduce risks and manage the process properly. So these are some of the reasons. What was great to see then is 75% saying that if they were to sell their business again, they would hire an advisor. So clearly entrepreneurs are seeing the benefit of having help on board. Again, probably too much detail to go through all of these on live, Baz, but I think this is gold dust for entrepreneurs. So from the 32 people that filled in the survey, we asked them each for their top recommendation to e-commerce entrepreneurs that will sell. A lot of them relate to financials, so it's about getting prepared financially is really, really important. That's key for due diligence of any buyer. So work with a proper accountant, work with a corporate finance firm, get your KPIs ready, and make sure your financials are bulletproof.
Yeah, that was the big mistake I made when I had my e-commerce business. I mean, I had for way too long time, I had a too cheap accountant and a bookkeeper, what resulted in that I never knew how my business was doing. And I knew it actually almost a year later. Oh, I made profit. Oh, I made a loss.
Yeah.
And if you want to sell your business, it needs to be on point every month. You have to know what your numbers are. Otherwise, you can't even sell because you can't hand over your numbers.
Yeah, big time. I think it's worth investing money in that, regardless of whether you're going to sell or not. Just frankly, for running a business, you need to have the numbers managed well. Well, there's lots of pieces of advice here. I think number 19 is interesting. When you're entering an exit process, keep running the brand as if you're the owner. Don't take your eye off the ball and think, God, in 2 weeks it could be sold. I'll get my big check. The deal may get delayed or fall away. So keep running the business until the deal
money's in the bank.
Until it's not over till the fat lady sings, as they say. Wait until the money's in the bank. And look, there's lots of advice here that are relevant that your listeners can take a look at. We can add the deck to the comments. So they were some of the key highlights from that survey.
Nice, great information, Emmett. Thanks. Thank you for sharing. I want to touch on patents as well. You see, like if people have a patent or these kind of things where they can protect it with, will the multiple be higher? Yeah, obviously it does, I think. But what's your perspective on that?
Well, I think for most entrepreneurs, it definitely they want to protect their intellectual property through brand registry and so on Amazon. If an e-commerce entrepreneur has the ability to get patents, that's brilliant. I think most don't. Most don't have something sort of so unique that it's patentable. Those that do should absolutely register those patents, and then because that makes a business so unique, it absolutely will be more attractive to a buyer. What buyers don't want to buy is a commodity type product that ultimately will face crazy competition from China and be a race to the bottom, and net margins will go from 20% to 10%. That's not what the buyers are looking for. They're looking for brands that have longevity, sustainability, and if there's something that's patentable that gives it something really unique that can be the foundation for taking that growth to the next stage. So yes, work with a relevant lawyer, IP lawyer, intellectual property lawyer to make sure that the documentation for the patents is in process or complete.
Yeah. Yeah, and talking about China, like I think maybe almost half of the sellers are Chinese on Amazon. And I don't know the exact number, but are you also doing a lot of deals with these Chinese companies then? They want to exit.
At the moment, we're not working with Chinese brands. We're focused predominantly on Europe and North America. That may change, but look, it's difficult to do due diligence on Chinese brands. Frankly, it's difficult to do due diligence on companies worth billions of dollars, hundreds of millions of dollars, let alone $2 million. So it's really tricky. Very few of the aggregators have entered the Chinese space. I think really the local aggregators will have a massive advantage in China, and there's 2 or 3 interesting local aggregators. The time zone is difficult for us to work with those brands. The languages is incredibly difficult to work with those brands. And ultimately, we don't bring a brand to market unless we can do our due diligence on the brand to answer most of the questions that dwarfs would ask. And I don't feel comfortable that our team can do that for a Chinese brand. So no.
No, I got it. I mean, you also see, it's not that it's only Chinese brands doing this, but there are a lot of black hat tactics to grow your brand on Amazon. How do you avoid you sell a brand to someone who used black hat tactics, and then you sell it to an aggregator, and once Amazon finds out it was a black hat tactic that they grew their brand, it will go, Amazon will wipe them out. Did that happen in the past with one of your deals, or?
No, well, we trying to ensure that any clients we bring on have not engaged in black hat activity, because ultimately we'll be wasting our time. All our fees are success-based only, Baz. We don't have upfront fee or monthly retainers. We only get paid when the business sells.
Right.
So we'll be wasting our time, because ultimately the buyers will see the black hat activity and just end the process. So we do the due diligence on it, and all the buyers have various ways to check if a brand has been engaging in black hat activity. Clearly, there's some engaging in grey hat activity, which can be borderline, and sometimes that's acceptable. But any proper black hat activity, isn't acceptable. You won't be able to sell your business to a reputable firm if you're doing it.
No. I was reading about this, and there are actually very big Chinese sellers did like hundreds of millions in Amazon. They get like just wiped out by Amazon because they were using black hat tactics. So it doesn't even matter how much revenue they do. Amazon doesn't care if you're using black hat tactics. You're right.
and rightly so. Yeah, I think it's great to see those announcements this year.
Yeah. Well, great, Emmett. We're more than an hour in right now. Is there anything you want to add to this conversation? Tell the people something or whatever you want to tell.
My advice for e-commerce entrepreneurs that have worked really hard, built their businesses is ultimately, I would assume that you want a big payday, like any entrepreneur. And to get to that payday, it's all about preparation. If you fail to prepare, you won't get the best deal. So start thinking about building towards your exit, your payday, ideally as far out as possible, even if it's 2 years from now. And we'd be delighted to have conversations with your listeners to explore how we can help.
Yeah. Oh yeah. Maybe one final question will make sense for Dutch sellers. Like, I mean, obviously I don't know how many Dutch deals you do, because if it's like only Dutch oriented, let's say they only sell on, I don't know, in the Netherlands. Is that even interesting for you as the Fortia group to do a deal with or help them selling their brand?
Yeah, absolutely. Provided it's of a certain size. So if revenue is getting towards €1 million or above, then we'd be interested in working with those companies. Yeah. So there are increasingly the aggregators are looking beyond just Amazon. And of course, there are other buyers as well, like private equity buyers that will take a look at brands. It doesn't matter, what marketplace or what country they're based in.
Great. Good to know.
Yeah.
Well, thanks a lot, Emmett. It was a lot of fun. Great information. And it was great to have you here. Yeah,
thank you so much, Baz. A pleasure to be on the podcast, and congrats again to all the Dutch with the fantastic F1 victory last Sunday.
Yes, great. Thanks a lot, man. Cheers.
Take care. Bye-bye.
Bedankt voor het luisteren naar de Ondernemen op Slippers podcast. Check voor meer informatie ondernemenopslippers.nl. Tot de volgende keer.
Oh, yes. That was the first English episode with Emmett Kilduff from the Fortia group. It was a lot of fun. Nice facts about the aggregator space. If you want to sell your e-commerce brand, you can contact them. Thanks a lot again, Emmett, and see you next time.